Since 1987, we've helped investors navigate the markets using technical research focused on relative strength, supply and demand, and momentum. From sector rotation to asset class rankings, we highlight what drives performance. Nasdaq, Dorsey, Wright, helping you stay one step ahead.
Hello, everybody, and welcome to this week's podcast for the week of July 30th, 2026. My name is Miles Clark. I'm joined here by portfolio manager Chuck Fuller. How you doing, Chuck?
Doing good. How you doing, man?
Living life. Hey, I was doing my homework looking the last time you were actually on the podcast, just like a one-on-one.
I can't even remember that.
Well, I'll tell you, it was August 1st was the published date, which is like some type of uncanny luck, right?
It's just been a year since I think.
You've been on, like, I think we did like a special edition with a partner or something like that.
Yeah.
But, you know, the pure Dorsey podcast, it's been a full year.
Jeez, we gotta change that.
Yeah, I
hear more often.
Well, I think maybe I lied, but I don't know. But we got you on in a pretty interesting time of the market or time of the year. You know, markets have started off Q3 not on the best footing, but still largely positive, largely productive for a lot of the names. But this is probably the point, as we are now about a month into this exhale, where people are starting to get a little bit nervous. Is this real? Is this not real? So we've got some conversations for today just to kind of, you know, talk through it. Yep. You've obviously looked at a lot of different market environments. You're not that old, but you've looked at a lot of different ones in your studies. So we will, you know, spend some time going through it. Just to give some context, over the last week, though, as we look at the performance for the names we typically do, crude, this was through yesterday, which was Tuesday, but crude was off 6, which is probably rebounded today a little bit on recording on Wednesday. Emerging markets down around 4.5%. The Nasdaq composite down around 3.5%, 4%. Towards the upside, only a couple names. The S&P 500 equal weighted index up around 2.5%, the Dow Jones up around 1%, and then long duration fixed income up around 70 bips or so. So very interesting spread. A lot of your areas that were doing quite well for so far in the year, not doing so well over the last week. S&P equal weighted index outperforming the cap weighted S&P 500 by about 3.5%. That is interesting, and a place I want to start.
Yeah. I think that's kind of the most interesting thing going on in the market right now. You know, overall, you know, the market obviously is still up for the year. You know, right. With this pullback, I forget what the number is right now. It's probably up 8 or 9%, right? Maybe a little bit less after today. But you got to remember, you know, we just came off a period where we had the Iran war, we had that roughly, you know, let's say 10% pullback. And then we had one of the greatest rallies we've seen in years and years and years, right? I mean, that rally off the bottom in March lasted, you know, just about 2 months until we got to the peak. And I think it was up about 19%, like at the best part of that. When you look at like 2-month returns there. But, you know, you don't typically see like a 2-month rally that strong, right? Like you have to go back to, I think it was 2020, before that, like off the COVID lows. Before that, you got to go back to 2009, you know, off the 08 lows. So it's very rare to see a move like that. And especially I would say off of a, you know, kind of a ho-hum decline, right? The 10% declines happen every year, basically.
Yep.
And so to see that kind of move off that, I think ultimately is bullish, you know, over the long term. Really the last time we've seen, you know, kind of a return like that wasn't off of a more major bottom was the 90s, which is obviously, you know, one of the historically greatest bull markets ever. Actually happened probably 2 or 3 times in the 90s there. And that's it, like for the last, let's say 75 years, that you've seen something like that. So it does make you wonder, you know, could this have more legs? And, you know, obviously after seeing just a massive rally like that in such a short period of time, the market needs time to digest, you know, some of those returns. And so, you know, I think we hit the peak in the S&P sometime in early June, something like that. You know, so we've had a couple months of digesting. You know, and really what we've seen, going back to your original point, is, you know, kind of the equal weighted S&P, which are, let's say, those other 490 stocks in the S&P, not just the top 10 that we're used to talking about. You know, those have kind of carried the baton, and kind of the previous leaders have fallen off a bit. And honestly, to me, that's a sign of a healthy market. It's a sign of just kind of regular sector rotation that you're supposed to see in an uptrend.
Right.
We more worry when it's the other way, right? When you got the leaders going straight up and all the other stocks aren't doing as well. That kind of divergence that you can see in the market, that tends to, bring up a top talks or bubble talks, that
Right.
kind of thing. And then they actually mean something. But this kind of thing seems to be more, just normal sector rotation. So that's what I'm hoping at least. But
Yeah, no, I mean, I think we all are. While you were talking, I brought up the default chart for SPX EWI, right,
Okay.
or the equal weighted S&P 500. I'm going to tell you this right now. This does not look like a chart that anyone would be really that worried about, right? I mean, you're looking at 5 consecutive buy signals, nice stair-stepping action after coming down to that positive trend line earlier in the year. Still actually at all-time highs as of, what is this, yesterday on this chart?
Yeah.
Right? So it's like, okay, well, you're seeing some of your big guys. The problem is, I think, probably that, so much of us or so many of us are probably over allocated to this stuff that has,
that's been doing
well. And so it feels a lot worse because, your microns, they're swinging around 5-10% in a single day.
Yeah.
And it just so happens that because micron's been doing so well, we haven't kept
you enjoy the upside volatility. You do not enjoy the downside.
Yeah, what is it? Downside capture and upside capture, right? You like your upside capture. But when we talk about this, obviously that gets into the conversation of participation. Earlier on in the year, we were a little bit concerned about participation being a little bit narrow. Now, do you think that that's actually propping up the market a little bit?
Yeah, I think that we've seen kind of a reversal there where, I mean, obviously kind of like what I was saying, the previous leaders have started to pull back, and in some cases by a lot, right? Like you look at a name like Oracle, it's down roughly 50% over the last 2 months.
Right.
And a lot of these, most of these are like kind of semi or computer related stocks that have pulled back so much. And really like what we've seen over the last couple months instead have been, kind of the old guard has stepped up. And when I say old guard, I mean like the names that used to be at the top of the market cap lists in the S&P. So I just, printed out a list of the names of the S&P and their kind of like 2-month performances. And I'm looking at it here, and the ones that are positive are, you got Apple, which is up like 25% this year.
Speaking of Apple, this is interesting. Did you see, I just saw some news thing or whatever that you can like now lease a phone for like $27 a month or something like that.
Yeah.
It's like if we look back a year from now and we're like a little bit in worse position, that's got to be a big top indicator. It's like the buy nothing or own nothing economy or whatever it is. Anyways, sorry, I got you off topic. Apple.
So yeah, you have Apple. If I keep going down the list, Berkshire Hathaway, Eli Lilly, JP Morgan, Visa, Johnson & Johnson, Exxon, MasterCard, I could go on and on. But I mean, these are all names that like when I first started, in the, at Dorsey, Wright, let's say in 2007, those are the names that were up at the top of the list. And those seem to be the ones that have been doing really well the past couple of months. And not just, it's not like they're eking out like, oh, it's up 0.5%,
right?
That kind of thing. If I look at the Johnson & Johnson up 18%, JP Morgan up 19%. So, I mean, a lot of these stocks are making, big moves, even though the market as a whole is just kind of moving sideways for the moment.
Yeah, they're seeing some meaningful positive relative strength over some of your semiconductors, which I want to talk about more in just a moment. I do think it is at least worth mentioning very briefly a reversal higher for BPSPX, which measures the percentage of S&P 500 stocks trading on point and figure buy signals. It's one of the flagship indicators we typically look at for broader participation. I'm sharing screen now. We actually got a reversal back higher on this chart just yesterday. So as of Tuesday, the 28th. But now 62% of S&P 500 trades on a buy signal, right? That certainly is lower than where we were in 2023, 2024, and 2025, but we're actually sitting at our 2026 highs on this chart.
Right.
So I just think that kind of adds to the conversation.
That's exactly right. I was looking at another one that's like that, the TWSPX, actually just this morning, and it's done the same thing. It's back up, I think it hit 70 last night, and just, continues making new highs. And so again, this isn't what happens when things are looking bad. Typically, when things are kind of weak, you'll see those numbers, really low. yet the market's kind of hanging up here and just going sideways or moving up.
Right.
That's where the real weakness is. So seeing this again, it just points to, just kind of plain vanilla sector rotation. It doesn't feel good because a lot of these stocks, again, like you said, were over allocated to tech and, semiconductors and all this kind of thing. But, to me, it's completely normal. And a lot of these names, like a lot of these semiconductor names that have pulled back, I mean, they're still up massively for the year.
Right.
They may have pulled back 20 or more percent. I think actually, if you looked at the SOX index,
I just typed it in. That's
I want to say it's down like 20%. But I think it's up like 63 for the year still.
Yeah, 63 before today, which we're down by.
Before today, yeah.
Yeah.
So I mean, it just shows you that this is what happens. I mean, you get massive rallies and things like you don't get the upside volatility without also incurring some of the downside volatility. And so, but then it just becomes, okay, when is enough?
Right. Well, and that's the question I want to talk to you about is maybe what research and, have you done of, and of course it's going to be different in every market scenario,
yeah.
right? But when is enough, right? For a lot of this, we've seen semiconductors come out a little bit of some of our models on the platform. Other areas, like you say, though, you're still up. Like you said, SOX is off 10, 15% off of its highs, or maybe even more. I'm not sure. But you're still up 60% year to date.
Right.
If you just looked at the 60% number, you would say, well, that's a good area. You want to be in there if the market's up 8, right? Yeah. But how is momentum going to digest this? Right now, we're about a month into this exhale.
Yeah. And so what I would say with momentum, the worst case situation is going to be a V top, right? Where you go straight up and then straight back down, right? Because that makes it very difficult for, if you're looking at it from a point figure standpoint, for a lot of these charts to kind of give you the back and forth action, you need to get sell signals on the chart.
Right.
And so far now we're only like you said, like a month or so into this. And so far it's been definitely more like a V, right?
Yeah.
Just get straight up and now it's kind of come straight down. But I would also say that the V top is one of the lowest probability things you see in the market, right? Because tops tend to be something that, that's like the market digests these things kind of slowly over time. And so I would put that, the idea that these stocks are just going to keep collapsing, maybe it'd be down 50% or whatever. Like, I think that's probably not going to be the case. They'll probably, they're down, whatever they're down 20% now, maybe they go down 25 or whatever it ends up being. Probably have some kind of, counter trend rally, at least, right? Or maybe they come back.
Right.
And so that's what's, it's tough. You never know what it's going to be. We've done research kind of looking at, our attribute system.
Right.
We always say, buy the fives there, the 5 out of 5 stocks. So they have all the attributes, going in their favor. But it turns out, if stock is a 4 and it's a falling 4, in other words, it was a 5 and came down to a 4, they're just as good as 5s, right? So it's kind of like a relative strength pullback by itself doesn't mean it's the end of the game for the stock.
Right.
Now eventually, it keeps going down.
Right. Because then it's a 3 and then it's a 2. And
but we've even like when I do this all the time at the catapult that we do, we're getting ready to have a couple months.
Shout out.
Join.
That's
right. Yeah. So, I always do this in my presentation where I show that, picking 5s and actually allowing them to fall decent ways, even down to be a 2 attribute stock. It works over time. And so these relative strength pullbacks that you get, I mean, they, by no means, as long as they were really good to begin with, it's not necessarily the end of the world for them.
Well, and that's probably that's the asterisk, right? Is that, you are in a stock that's up 100, 200, 300, 400%.
Yeah.
They've got enough of a leash, right? Where they're successful enough to let them drop 20, 30%, 50% even sometimes. And you're still, and you're still well in the green.
That's one benefit of relative strength is it will actually keep those in.
Yeah.
Right. Like if the stock that's only up, let's say 20%, right? Like, and it drops that much, well, it's probably going to get kicked out a lot sooner.
Right.
So,
well, while we're talking, I just want to, bring up RF spread, which I think we have now hit on with myself and Trevor last week, myself and Ian 2 weeks ago, and now you and me today. each week it gives us something fun to talk about.
Yeah.
RS spread is now sitting on its chart here at its trend line. Now, I don't know if you've done any tests about trends and RS spread or anything like that.
Yeah.
I haven't either, for what it's worth.
Yeah.
But point is that when this value is decreasing, that just means your laggards are doing relatively better than your leaders. So we have seen over just the last month or so, this value decrease a lot. So, or in layman's terms, right, the laggards do really well in comparison to the leaders. So I don't know. I wouldn't, again, since I haven't done any testing on it, I don't know if you've done, but I wouldn't put too much in the way of, if this breaks trend, it's a bad thing for momentum. But this is a really good viewpoint on how those laggards are doing.
Yeah. The one thing I will say, the one thing I do know about when you see very fast kind of declines in this, a lot of times it's off of like a more major bottom. Right. So it's kind of like the laggards got killed, right, more than anything at a bottom. And then, of course, you actually get to the bottom and they take off like you wouldn't believe. Obviously, that's not the case here. So it kind of makes me think that, the laggard, this is kind of just a normal pullback again, right?
Yeah.
It's not that the laggards are going to run for the next year, which a lot of times that's what happens in those situations, is that those laggards will run for the next year.
Right. And then they become leaders.
And
right?
then they become leaders, right? So my guess is that's not what we're seeing, given, especially with everything else that we're talking about. That this is probably just, normal sector rotation, at least over the short term. And we'll just have to see how it goes.
What sectors, not to put you on the spot, what sectors are you watching? I mean, obviously industrials, they've been leaders for a while. They've struggled a little bit. Healthcare and biotech, right? They've moved up from the bottom, right?
Financials as well. They've kind of moved up. Real estate is quietly, doing pretty well.
Right.
So it's all those kind of things, kind of like somewhat of the old guard, right? Financial stocks used to be a much bigger weight, and everything than let's say what they are now. Tech has kind of displaced them, to a large degree. But yeah, it's just kind of, all the old guard, and obviously still watching tech. Yeah. I mean, if you look at where it is in Dolly, I think it's, down at number 3 now. Obviously it wasn't number 1. But I mean, if you look back at the history of the dollar rankings, I mean, there's all kinds of times where it kind of pulls back to 3, 4, maybe 5, and then it's back off to the races again. And I think you have to, if what all these hyperscalers are doing for the AI trade is a legit thing. I mean, they're talking about spending $2 trillion over the next 2 years.
Right. It's monopoly money.
Yeah. And like all that money's going somewhere.
Right.
Basically all these other tech stocks and industrial stocks and all these kind of things that are involved in the build out. Now maybe that doesn't come to fruition. Maybe, something happens, that causes them, but it's, even if it's half of that number, if it's a $1 trillion, right? Like that's just still a lot of money that's going into the market. I think one thing that does worry me a little bit is just, a lot of those companies, are now kind of running out of free cash flow to spend on this stuff. And so,
what was it? Google, I thought I saw in their deal, they were like first time ever that they had negative free cash flow or something like that.
They're starting to take on debt to finance these things. And so that's where it starts to get a little bit trickier for them. Not to say that they can't do it. I mean, these are obviously super smart people who were making these decisions, but, that's, it becomes a different animal, I think, once you start involved with debt. And
eventually people need to get paid, right?
You're right. Yeah, exactly.
I mean, eventually, and we've been saying that, right? And this gets out of the technicals a little bit more of the AI story or some of the fundamentals, whatever. But there does come a point where, somebody needs to see some type of return on something.
Right. Yeah. We're all, using AI more at work and that kind of thing. It's like there needs to be some measurable outcomes.
Well, we've been saying that for the last year, I guess. I mean, that's the argument, I guess.
Yeah,
longer than.
And people keep saying that it's coming, and I have seen some things. I think there is something to the point of, people don't know what these things can do. Necessarily, and I'll put myself in that bucket of, I use something like ChatGPT. I'm still asking it questions, like I might, type something into Google. But really, like when you look at what the capabilities of some of these things are, it's a lot further along than what you think, but it's not the kind of thing that an average person would think that they could do. Like,
Yeah.
oh,
It's
hey,
almost like the limitations are not not computer related. They're actually just human creativity.
right. Like, hey, ChatGPT, make me this entire iOS app right now in like 5 minutes or whatever. Like, it's sad that you sound stupid saying it out loud, right?
Yeah.
But to some degree, it's starting to be able to do things like that. So I think there's kind of an education process, and I think that's what they're starting to do. I read something not too long ago where, Anthropic and OpenAI are starting to. They have these task force, like going into companies to try to get the employees to use it in a way that can boost productivity, because they know at the end of the day, if they don't, these outcomes aren't shown,
they're not good. They're not using it.
Then their valuations aren't going to be up at $1 trillion anymore, right? Like, so, I think they're probably doing the right things, but we still haven't, I don't know, gotten to that point where we're seeing that measurable outcome. But I think, man, if we do, the second that does come in, if we do, it could be crazy.
Yeah. Well, we talk about catalysts for upside movement. Obviously, we've got, rate cut or rate hike decisions that's coming out of, I think, 2:00 or whatever that is. That meeting is literally
right now.
has been happening as we speak. We should look at the market. Earnings, obviously, for a whole bunch of big names. You've got the likes of Meta, Amazon, Microsoft. They're all reporting within the next 24 to 48 hours, Wednesday into Thursday and everything like that. So, there's a whole bunch of catalysts outside of just the pure technicals that could possibly spur on, right? Maybe looking a little bit further into how some of these other hyperscalers are spending, right? Maybe you're seeing a winner or a loser there, maybe this quarter, next quarter, who knows? But there's certainly a lot coming down the pipeline and everything like that. Was there anything that you wanted to touch on today that we didn't get to or anything like that?
I'm trying to think. I mean, we went over, like the eco-weighted stuff, the pullbacks. I don't know. I think that, to me, there's still obviously this question of a bubble, that's out there. Is that what we're seeing as the popping of the bubble? I think usually when people talk about that, they're comparing it to like the 90s, right? And the popping of that bubble. And I would just say, like, I don't think that we're really at that point yet, at least when you look at the data, right? To me, it feels much more like, what people were saying in like 1996 or 1997 versus 1999.
Right.
I'll just always, and I remember this happening. I mean, I was a teenager at the time, but I remember Greenspan coming out and talking about how the markets are going through a period of irrational exuberance, right?
Right.
And that was like, later on, I went and looked up when that was. It was December 96. And we had another 3+ years of major rally to go. Right. Now, within that rally, like by the end of it, you start to see a lot of things taking place. Like you start seeing like, the average stock, topped in 1998. Right. And like,
then there was a big, there was a
huge divergence. Divergence like you can't even imagine. And like, really, you saw the same thing in like the late 20s. You talk about like the leading into the Depression. Those are the kind of bubbles that usually when people ask that question that they're talking about. And that's one of the telltale signs of that kind of thing. Also just having like insane longer term returns, right? Like part of a bubble is that like, oh, we went up a bunch, right? Yeah. It's like the simplest way of looking at it. Well, I mean, we've been up a lot, but like if you look at like the last 5 years of return, it's actually pretty average, and part of that's because 2022 is in there, which was a bear market, right? We went down almost 30% there. And so, I think that, from all these kind of metrics, if it is a bubble, it doesn't look like anyone that we've seen in the past so far. Right.
The unfortunate thing that I will say is that is typically how it happens, right?
Yeah.
It was something that's completely new. Anyways, I'm not trying to sound like I'm bearish, but that's that. I guess it wouldn't be a bubble if it looked like every other one, right?
There is a point to be made there. So.
Yeah. Well, are you good? You got any other final?
No,
okay. Yeah. Well, Chuck, obviously it was a wonderful time sitting down with you. Always great to have you on, get your insights into, what you're seeing from the bigger data side of things. We'll get you on before next August 1st, right? But again, I appreciate you all listening, joining us today. As Chuck mentioned earlier, we have our annual Catapult event that's coming up at the end of September, early October. So we'd love to see everybody there. We'll throw the link to register and more information, stuff like that, down in the description. Always give us a call or shoot us an email if you got any other questions about that. Otherwise, I hope everyone has a wonderful and safe week, and we'll see you again next time.